Mr. Loo, Goldman Sachs says that the next 10 years, S&P 500 will only average 3% growth a year, right? So, it's very bad. Yeah, put money into the special account also higher than that, right? So, Mr. Loo, let's not invest in S&P 500 anymore, man. I think it's going to be shitty. Well, ladies and gentlemen, Goldman Sachs just predicted that, it's going to be pretty shitty for S&P 500 moving forward. I think it's very important we take a look at this prediction because it might affect all of you in the next 10 years. And most importantly, I'll give you the most important conclusion, which is my reflection of this prediction. Let's watch on, shall we? So before we start, these are our usual disclaimers. So remember to hit like and subscribe for our YouTube channel as we bring you very real-time analysis of the economic environment and also stock market implications that will help you in your investment analysis. So let's go. So Goldman Sachs actually made an interesting announcement today that they have a prediction that says that S&P 500 will have an annual growth rate of 3% over the next 10 years. 3%, right? 3% is hardly, inflation rate. So the S&P 500 is expected to post an annualized nominal total return of just 3% over the next 10 years, according to analysis by strategists, including David Kostin. And this is an important name, David Kostin, okay? This compares to the 13% a year over the last decade and a long-term average of 11%. So take note, the long-term average has been 11%. Last 10 years was 13%. Now you go down to 3%. And they also see a roughly 72% chance that the benchmark index will trail Treasury bonds and a 33% likelihood they will lag inflation through 2034. Right? So the returns that the S&P 500 will be giving is even lousier than the Treasury bonds and even lousier the inflation rate. So that's what their prediction is. So how on earth did they come up with this prediction? Well, they use a complicated, sophisticated economic model. So Goldman Sachs analysts say that they have found that a model incorporating starting equity valuation, initial market concentration using 10-year Treasury note yield, initial S&P 500 return on equity, and an estimate of using forward economic contraction frequency best help explain and forecast long-term equity return. Well, this sounds like a lot of very sophisticated thing and far deeper than what we used to have in our economic school. But let's see what's the details. So number one is market concentration. And this is their hypothesis that most of the return of the S&P 500 was concentrated in a few stocks, namely the Magnificent Seven, right? We have got NVIDIA, Alphabet, Facebook, whatsoever. And these kind of returns that is only driven by a few stocks is unlikely to maintain this kind of high profit for a long time. So common sense logically is that, this kind of spectacular return driven by high density few stocks, it's very difficult to sustain over a long time. So therefore, these stocks return will start to go down. As it goes down, S&P 500 will start to go down in terms of growth rate as well. That's one of their major conclusion. And they did say that in 1960 and 1970, there were some large cap superstar companies as well, such as IBM, Kodak, Xerox, and whatsoever. At the time when they go down, it turned out to be a lost decade for the stock market returns, right? So they also said the same thing in the light of the dot-com bust when Microsoft, General Electric, Cisco System, and Intel were to the moon, and then suddenly it burst, and then you return a very long period of shitty return. So that's their analysis, right? History of that kind of high concentrated return will repeat again. Number two, they use a sophisticated model and say that the equity valuations is actually too high right now, right? They use a complicated model called CAPE, CAPE. Well, it basically says that the higher the starting valuation, the lower the future return. So the current CAPE ratio is 38 times, which is in line with the 97 percentile, which is very, very high, okay? And this is too high, and as a result, future returns, cannot go any more higher in a very big way. So therefore, it will go down, right? So basically, without knowing the mumbo jumbo behind all this, basically prices are too high right now. This is quite an interesting estimate this is quite an interesting prediction they're making. They actually says that the US will have 4 GDP contraction in the next decade. So GDP contraction simply means that more closer to a recession. So they will expect that the economy will contract by 4 times, right? 4 times over the next decade, and that's quite serious, right? To have a economic recession of 4 times, and these 4 times will slow down everything. I don't know how they come up with the magical four. I will just say that the last few times, GDP contracted were based on things that are very difficult to predict, right? But they predicted four, right? I don't know whether this will be true or not. Last is corporate profitability. They also predicted that the corporate profitability will start to decline for the big corporates, and this would have an outsized impact for the entire market. And the fifth one is that the 10-year Treasury yield, okay, is right now trending to 4%. And people will start to recalibrate their expectation, okay, because the rate cuts is not going to cut as much as they hope, and there will be a persistently hot inflation. So all these will all come together and cause a 3% growth in the S&P 500 over the next 10 years. It's important for us to see what are the other predictors and their prediction, right? So Goldman Sachs says that 3% a year for S&P 500 over the next 10 years, okay? And that's even worse than you put money into a special account. But on the other hand, we have got a super bull from Fundstrat, Tom Lee, who says that the S&P 500 will grow, to 1,500, will grow to 15,000 points. 15,000 points by 2030, right? That's a 156% increase in 6 years, right? So one is here, one is here, right? So who is right, who is wrong? Let's take a look at how the Tom Lee predicts. So Tom Lee explains that the S&P 500 could hit 15,000 by 2030, and let's analyze why he said. Let's analyze why he thinks that you will hit 15,000 by 2030, shall we? First of all, he predicted that earnings will grow by 12 to 15%, and the P/E ratio will grow at about 5% a year. So this is quite different from Goldman Sachs, who predicted that the earnings will grow, actually pretty badly, where Tom Lee believes that the earnings will grow actually pretty strongly. So the key observation by Tom Lee is this. I think there's one thing to keep in mind is that COVID has proven to us that businesses are a lot more resilient than we realize. And I think the multiple can compound at a higher rate than 5%. So this is what he thinks that the market will go to. And he highlighted two factors that could drive the entire stock market. One interesting thing that he says is that there will be a surge of people reaching their prime age of 30 to 50 years old. This group of people that are coming to 30 to 50 years old will be now a big group. And these are the big spenders in life. And these are people who spend a lot, borrow a lot, make huge buying decisions and things like that. So this is a big demand story, as what he says. So when you get to your prime age of 30 to 50, Urban Institute shows that you start to borrow more money and you're making big decisions in life, which powers the economy. Second thing that he said is there's a global labor shortage. And as a result, many companies are forced to spend on tech and tech research and tech innovation to address this labor shortage. It's quite important because as the company turns to technology and automation to make up for the gap in prime age workers, ultimately spending trillions of dollars on silicon-based technologies that can enable robotics and artificial intelligence. So basically, there is a belief that workers will be not enough. Companies will then have to spend a lot on technology, and that will drive the entire stock market up as well. Here we have Goldman Sachs believe that the next 10 years is pretty shitty. Here you have Tom Lee, who believes that the future is going to be rosy. Who's right, who's wrong? What do you think, right? The best way of looking forward is to take a look at their track record in predicting, shall we? So who is a better predictor historically? Goldman Sachs have a track record of making very bad predictions historically. So let's take a look at some of their predictions, shall we? So Goldman Sachs predicted in 2022 that 2023 will end up pretty bad, right? So this is the headlines. US stocks are forecast to have less pain but no gain in 2023. And the S&P index is forecast to turn out flat returns with no growth in earnings in 2023, okay? That is the prediction. Remember this name I mentioned just now, right? David Costin, Chief US Equity Researcher, who wrote this in 2023. Simply put it, zero earnings growth will drive zero appreciation in stock market. So he actually said this for 2023, right? This was the S&P 500. They think that the market was hover some around here. Guess what? The stock market hit so high, right? So he's not just wrong, he's very wrong. So Goldman Sachs also then make another prediction. He predicted that in 2023, that 2024 is expected to return 6%. Not too bad, 6%. The same guy, David Costin, says this: our analysts expect S&P 500 index gains to be concentrated in the second half of 2024, okay, and forecast to return 6%. Right now, okay, for S&P 500, we are now beyond the charts at 5,800 over points already. So then they make again a prediction in May this year that the S&P 500 will stay at 5,200 points until the end of 2024. So again, this guy, David Costin, S&P 500 is going nowhere through year end, says Goldman Costin. So the S&P 500 index is unlikely to deliver any more gains from now to the end of the year, say David Costin. And the chief equity strategist reiterated that his 2024 price target of benchmark 5,200 points now is 5,800 to almost 5,900 points already. I mean, there's a degree of wrong that you can make, right? Yeah, he's not just wrong, he's consistently wrong by a huge margin, right? Consistently wrong. And I actually wonder how come he can keep his job, right? You know, it's not just wrong, it's so wrong, right? It's so wrong. And that's something that we really need to be mindful of before we see him coming out this kind of unusual prediction again. So there are analysts who comment about David Costin from Goldman Sachs prediction. So this guy, Michael Fair, a high power advisor, chief investment strategist, says, things advance and technology advance, the world advance. I don't think you can ever bet against the US market or US economy. It's basically saying that, David, you are not just wrong, yeah, you are going to be very, very wrong. So what about Tom Lee's track record in his prediction? So Tom Lee predicted that the S&P 500 will hit 4,750 points for 2023, and it did, right? It hit exactly 4,769 points at end of 2023. And that's amazing, right? So his track record of making an accurate prediction is amazing, right? And then earlier this year, he predicted that the S&P 500 will hit 5,500 points by end June. And S&P 500 did reach 5,500 points, not end June, 2nd of July. Very, very close really. So he has got amazing track record of making insanely right prediction. So now that you've seen the prediction and the track record of their accuracy of their prediction, who would you believe? Before you get panicky by reading headlines, know that history is on whose side. Would you choose to believe Goldman Sachs' David Costin, who has been consistently making wrong prediction, or do you want to believe someone else that's more accurate? This is your call. I tend to believe that the S&P 500 has a track record over the last 100 years of doing this. Is it possible that the next 10 years we get hit by a lost decade again? Yeah, anything is possible, right? You know, the geopolitical environment is risky. I agree with that. I also agree that there are inherent risks involved, as seen by yesterday's video. But I choose to believe that over the next 10, 20, 30 years, the S&P 500 will continue to compound with an average growth of 8 to 12% at least. And that is my belief. There will be a lot of volatility in between, and we should consistently keep ourselves in the market, but rebalance when things are a bit out of the ratio, like what I did. So I've already told everybody that I have started my rebalancing exercise. So I've also informed everybody in my Telegram group that I started selling some NASDAQ, and I actually screenshot my sale on the Telegram group so that you know that what I'm doing. And this is in the spirit of transparency. You should always join us in our Telegram group so you get real-time updates from us. So with this, thank you for watching. Okay, make your own judgment, and I'll see you in a day or two. Thank you and goodbye.